Good morning and welcome back to Money Control. The markets have kicked off on a slightly positive note, 300 points up on the Sensex a day after precipitous fall. Interestingly, there is some buying interest that is coming into stocks that are going to see serious cuts in business. All the capital market stocks, BSE, Angel One, etc., are seeing slight amount of nibbling this morning, up about 2%. The ongoing nervousness in the market, is this an opportunity to buy, or should you be sitting on the sidelines and wait for better prices to emerge? I'm Mahalakshmi and I have with me S. Naren, CIO of Prudential ICICI AMC. Good morning, Naren.
Good morning.
So your first take on the budget, anything apart from the STT that really surprised you?
No, actually, because see, over the years, what has happened is GST has ensured that the budget goes out of the budget does not focus on GST. So direct taxes have reached an equilibrium that one can't expect big changes. Neither can you expect big changes in import duty. So it becomes a occasion for the government to share what all they are doing in various sectors in the part A of the speech. So that's why I would say there is less focus at this point. There can't be the old budget of 1980s and 90s, where each budget was like, bringing down customs duty, bringing down excise duties and various other things. I don't think you can have that kind of a budget today.
True. Anything that changed at all for you before the budget and now, because there were lots of policy support for a lot of new sectors. Anything that you picked up that stands out?
No, I think STT change is a welcome step because, frankly, if you ask me, the retail derivatives are the investors are the biggest losers. And against that, maybe some of the bigger HFTs and others are the biggest gainers. So what happens is it's a welcome long-term step with a near-term challenge, and that was clearly one of the events which stood out in the budget because the government is willing to take a long-term positive decision for a short-term negative decision. And that is what was one of the clear messages from the budget. And this is not the first time they have done it. If you look at it, they took an action on gaming also, which was something like this. And at that point of time also, it was a long-term positive decision with a short-term negative decision for many of the gaming companies. So I believe that the government has not flinched because they know that it is more important to focus on cash market, much more important to focus on investment oriented things than to focus on speculative oriented things.
Right. But do you think, a tax will really deter people from getting into derivatives trade? And is this the way to, address the problem of retail traders really losing out on the market? Because the hurdle rate has gone up, but the mindset to gamble or the hope that you will eventually make money in derivatives, the greed for, making quick gains, that will continue to, make people look at this market, right? So does this really solve that problem?
In a country like India, can you have a situation where only accredited investors can trade derivatives? Is that what is a model that is possible? If that is possible, that is possibly a better model. So then you tell people to write an exam, and then only after writing the exam you clear it, you're allowed to use derivatives. Is that kind of a model possible? For example, you take in specialized investment funds.
Yeah.
The number of people who have cleared the exam is very few, and that is for people who are actually engaged as mutual fund distributors. Imagine you have to tell retail investors to take an exam, and only if you pass the exam you will be allowed to do derivatives. That would be a far more draconian step than this. And this is where the government always has challenges. It is easy to think what to do. So you increase the size of a contract, you increase STT, you do all these kind of things. You allow only one settlement per week. And all these kind of things you do. What else can you do at this point of time? Because end of the day, you are in a situation now. What is the step? Do you want accredited investors only to trade derivatives? That's another model. I think some other countries did it, and
Yeah.
that is a very tough model in a country like India to do it.
You're saying accredited investors will be a difficult to implement, and therefore this is a better.
Yeah, just imagine if you told only people who passed a certain exam can do derivatives. Is that a possibility? I don't know whether
Why
that
not?
kind of.
Why do you say that? Why
I
is
mean,
not? For
I.
example, in
Oh,
SIFs, now your the mutual fund industry is going through that step, right? I mean, it is a hurdle, but you are making it
but these are
mandatory
for
for.
people full-time engaged in mutual fund distribution who are actually
Right.
doing it. So here, investors are part-time investors. If you tell investors you have to pass an exam to write, and then only after that you can do derivatives, I mean, the number of participants in derivative segment will go down in the retail side by maybe 90% or 98% or something like that. I mean, I'm not an expert in these kind of things. Luckily, I'm not in regulation of these kind of things. So I would say that this is the challenge from a government point of view or a regulator point of view.
Right. No, one of the things I'm asking this question also because one of the things that we picked up is that this disproportionately hurts this hurdle because of taxes, disproportionately hurts high frequency trading because the threshold is now higher. So it will encourage low frequency traders as opposed to high frequency trading, which actually in a sense, of course, if you are ignorant about derivatives market, good luck to you. Whether you win or not will depend upon how much you know your trade. But in some ways, theoretically speaking, it levels the playing field for high frequency versus low frequency traders.
Absolutely.
So that is one thought. So this is not so much that retail investors are losing money, but the stranglehold, especially after Jane Street, the stranglehold that high frequency traders really have on the market on the derivative segment, that I think will get altered. What is your take? Do you agree?
Absolutely. See, any step which increases cash volumes and reduces derivative volumes is genuinely positive. And India has been a market where derivative volumes has been much higher than cash volumes. I think even today in the US market, there is no concept of stock futures. And there is, so if you look at it, stock futures is an India concept. I don't think it's available in US.
Right.
So what happens is that these are things, as I said, government has a tough task of thinking, if you look at this as SEBI data, you clearly know you have to push the cash market up and you make the derivatives market smaller. Possibly this step will make the cash market bigger and that would be a good step.
Right, understood. But from an institutional perspective, Naren, what does this mean? For example, now SIFs, the specialized investment schemes where you're allowed to do, long short, that was seen as a very welcome move. Now everybody has launched their SIFs. Does this, create some sort of, because now if you have lower liquidity, then the bid-ask spreads will be higher. How will all this play out for SIF returns? Does it change the return? Do we have to change the return expectations meaningfully?
No, I think clearly there will be a certain amount of taxation increase which will be there. It is much clearer in an arbitrage fund, which would be, I think, where the return will go down by 0.36% per year or so. In the case of SIF, it depends on to what extent you are going to use derivatives and what form of derivatives, etc. So, but in arbitrage fund, it is much clearer. So, I believe that finally at the end of the day, we have to create good products, and whether we'll use much more of cash rather than derivatives, depending on what finally at the end of the day, we have to deliver a good investing experience to the investor. We'll have to look at what we have to do.
Understood.
But we were never focused on only derivatives as a strategy in SIF.
Right.
I think derivatives alone is a strategy.
Understood. Also, how do you see the capital market stocks, because they obviously were at the receiving end yesterday. Today we see some kind of nibbling. Overall, what is your sense on now NSE IPO will also come because they've got the no objection certificate from SEBI. BSE today has seen a little bit of uptick. This entire stock market ecosystem, stocks, whether it is exchanges, brokers, etc., From a stock perspective, how do you see this as an opportunity? More cuts, do you think, or is this time to start nibbling?
It would depend on how investors are going to behave. That is a very difficult question at this point of time. India is one of the best capital market infrastructures in the world, maybe. And so how this plays out is something which is difficult for us, to understand. Basically, one of the challenges, is what we look at cycles. And in cycle, we have seen that starting 2013 or 2012, there has never been a down year in Nifty.
Yeah.
Because you have not had a down year in Nifty, I would say that the cycle is advanced. So, in a very advanced cycle, we believe that you have to be a bit careful, because end of the day, what we have seen is that, since we are big believers in cycles, this is one of the few sectors where there hasn't been a cycle from 2012 onwards, and it has been up and up and up virtually except for 3 months in COVID. So I would say just from a cycle point of view, one has to be a bit careful, and that is the challenge, which is the reason, as considering we manage public money, the most important thing we keep telling is asset allocation. Because there are so many investors in the market who are not used to negative returns. So, we have to keep on telling them asset allocation, asset allocation, and asset allocation, because they have not seen negative returns in markets. And that is the same thing accounts for even some of the capital market intermediaries. Although the capital market infrastructure that we have created is just outstanding.
Yeah.
And thanks to good regulation and the infrastructure that we have created, we have a very good system. But from a cycle point of view, we are certainly worried.
Understood. So you're saying we haven't seen cycles, which I completely agree with, but the markets have been sort of in a nervous consolidation mode for more than a year and a half now, at least a year and a half now. And this year, especially, after a very lackluster 2025, people were hoping that 2026 things will change. But this January also has been extremely disappointing. How do you see, from a slightly, 2 quarters out, do you see the market mood really changing, or are we in for a longer period of consolidation, considering where we are in the earnings cycle and the valuation cycle?
I think 2025 also was an up year for Nifty, if I'm not wrong. And
Nifty was up 6%. I said
6%.
Lackluster. It was not a down year. Yes.
Yeah. So, unfortunately, what has happened is people in India always expect 10 to 15% all the time. And due to that, what has happened is valuations have become extended, and we are forced to talk of asset allocation all the time. The reality is there are very few stocks which are available at sub 15 trailing PE even today. After, if you look at it after this thing, except a few maybe banks and a few sectors in oil and gas and coal and all those kind of sectors. So I would say, Indian market is not dirt cheap at this point of time. It may have one of the best structural stories for the next decade, but it is not a dirt cheap market. So even though markets may not have delivered stupendous returns like what some of the other markets like Korea and Taiwan and US Nasdaq has delivered, I would say India is not a dirt cheap market. The only difference between 2024 end and now is that all markets in the world are not cheap. So it is tough to find a cheap market in the world. Possibly we can't see a cheap market in the world. And that is a challenge at this point of time. And but having said that, I don't think there is any dirt cheap market where you can say now the market is so cheap, or there's a sector which is so cheap that you can put big money to work at this point of time.
Right. No, dirt cheap, of course they are not. But do you think this is a fairly priced market, or is there still some froth that you would expect will see some more significant correction before valuation stabilize?
The froth is much lower. The froth is still there, but it is much lower than what it was in 2024. Even now, you can see stocks where the valuations are not are high, but the level of froth has come down substantially. But the level of froth is different from the level of cheapness. I think the level of cheapness doesn't exist. The level of froth is certainly down. So that's why you are in this moderate, you have to be in this moderate return asset allocation camp when you're managing public money without determining what is moderate returns. So when people ask me moderate returns, we don't give a number, because the moment we give a number, people will feel too comfortable, because as it is, people believe equity is risk free. So point is that we don't mention the moderate return, so that let them think what is moderate return, and if later it turns out to be a low number, we'll tell you it is moderate return.
Okay, tricky. I mean, how do you interpret this moderate return? Fair enough. But tell me, you opened a subscription for small cap for your small cap fund recently, and you were very, very vocal about the overvaluation in small caps and the frenzy at the peak of the frenzy. Is this an indication that it has now become an area where there are opportunities for outsized returns, or what is the thought?
There are opportunities for returns. There are no opportunities for outsized returns. The fact is that there was froth in 2024. The level of froth in small cap has possibly come down significantly. So we said that even if we reopen, there is not going to be any situation where we are going to struggle with the amount of money that we are getting. So we said we can reopen it, but I don't think we are in a period where there is scope for outsized returns or something like that. But within an asset allocation framework, can you consider a small investment in small cap, or consider? Yes, you can, but look at it. 2-year SIP returns in small cap are close to zero at this point of time.
Yeah, yeah.
That was the thesis behind our entire cautious call, that people believe that in an SIP you will get always big returns, but the 2-year SIP returns were low. We are very comfortable. You start an SIP now and invest for the next 5, 6, 7 years. Maybe you will have a better experience. Whereas 2 years back, when you are in stratospheric valuation of small cap, you're actually, those SIP investments get invested at high levels. Whereas from now, froth is gone. So next 5 years you do SIP investing, you're in a better shape than what you were before.
Right. I was just looking at some numbers. We did this data for yesterday, that more than 70% of the small cap index, the BSE 250 small cap index, are still quoting at valuations, just statistical valuation, PE above 50. So now to sort of even consider that set is somewhat reasonable, is the expectation that the earnings recovery in small caps will be much sharper compared to large caps? Is that a reasonable statement to make?
See, one is you can look at the balance 30%. Second is that at the extreme bottom, you never get money. So if you try to ask for money at the extreme bottom, it doesn't. Hoping that if SIPs are started today, when small caps are not at extreme bottom, they'll continue when the markets are at extreme bottom.
Right.
So one of the learnings that we have from a 21-year experience, that 25 years in ICICI, is that you can't aim to get money at the bottom.
Right.
If you try to aim to get money at the bottom, you will not get it. If you aim to try to lose money, if you think you lose money at the top, that also won't happen. So your situation where it is best to be start becoming more positive as soon as froth goes out, and hope you start getting money and you continue to get money at the bottom. It is only continuation which is possible, not new money. New money is very tough. It will happen for that 0.5% of people who are great investors, and they could all be direct equity investors as well.
Right. That is a very, very interesting insight, Naren. From a business perspective, you can sort of time your, fund launches, etc. But from an investor perspective, if anybody who has been sort of on cash or sitting on the sidelines because they think that the markets have been overheated, is this the time to start to build your portfolio again, or size up your portfolio again, so that you don't wait for the absolute bottom to form? Would you say that that's a better strategy?
So we are in the middle, in the sense that FIs have been selling, locals have been buying. So we are in the middle, and that's why asset allocation works. Is it a time to go gung ho on equity? Answer is no. But at the same time, is it a time not to invest at all? The answer is no. So you're somewhere in the middle. Are we more positive than we were 12 months back or 24 months back? Yes. But does it mean that we are gung ho and thinking you'll make big money? I don't think so. There are risks. There is a possibility of a global equity correction. If that global equity correction comes and at that point of time markets in India correct, at that point of time maybe things would be much better for us to be more positive at that point of time. More positive than we are today. Are we more positive today than 1 year back? Yes. But can there be better period when you can be gung-ho on equity? It
Right.
looks to us.
Understood. Any quarters, Naren, where you think the earnings recovery will be outsized, in the sense that you see faster turnaround in earnings? Are there any?
Yeah, actually, we are seeing good turnaround in earnings in non-ferrous metals. We are seeing reasonable returns in oil and gas. We are seeing, in fact, most of the public sector banks have delivered good returns. The question is whether all the sectors which have delivered good returns, they are going to show big growth from here or not going to show big growth from here. Actually, we are in a phase, what Howard Marks says, you can have a pendulum which can go from extreme bearishness to extreme bullishness. We are somewhere in the middle. So we struggle to have that kind of middle. Surprisingly, is there in a wide variety of sectors at this point of time. Not one or two. That we are in the middle in a wide variety. So if you look at FMCG, growth is not there. If you see IT, growth is not there. These are sectors which have underperformed meaningfully.
Right.
If you see sectors like metals, some of the metal stocks have done very well. If you look at some of the banks, they have done very well. But then, so as the earnings come, can earnings keep growing like this in banks? May not be. So we are in a situation where, in a pendulum framework, which Howard Marks talks about, we seem to be in the middle on many things.
And what are the sectors or segments which are at the extremes?
That's what I said. No, we're not able to find. We used to think all these electronic manufacturing areas were all at extreme in terms of positive, but they're corrected now. And are they still in our framework? Are they in the middle? No, they still look costlier. But those are some of the few areas, at least, where it looks like still costly. And you can individually find there are costly stocks which have delivered well. But whether they'll continue to deliver is the question. So we are not in a phase where across equity market there is either euphoria or fear. There's neither at this point of time.
Right. Yeah, you're absolutely right, because yesterday, one of the bright spots was there was a 18-19% increase in capex for defense, and yet defense stocks corrected. So good news also doesn't go through well with some of the overpriced stocks. By the way, what is your take on defense and railways? Do you own any of these stocks? Do you like the sector?
See, defense, my colleagues who are more growth oriented, they find very interesting ideas where you have to do bottom up work and work on them. With a value mindset, I find it very difficult to manage to look at some of the defense stocks. But the growth-oriented investors do find it interesting. Railways, the valuations are also high, and the growth is also not as good as some of the other sectors. So we are not focused so much on railways at this point. Notwithstanding the fact that some of them have delivered huge returns in the last 5 years, right now from here we are still cautious.
Understood. Naren, usually what happens is in consolidation phases that we have seen in the past, where the market sort of drifts, it is markets tend to sort of overpay or give a slightly extra valuation or premium for companies which start to deliver on earnings consistently. Are there any quarters where you find that you can see this earnings consistency which will justify slightly higher valuations?
I mean, if you look at select auto stocks, you do see it. Select banks, you see it. So yes, there could be, but as I mentioned, people force us to give that there are sitter opportunities across. No, there are no. At least maybe there are some small companies we don't know about, and but the sitter opportunities are not there. We are in a moderate return environment in between greed, in between euphoria and fear. So that's where we are. If you ask me why did this happen, I think I'm clear. It is because the euphoria shifted to precious metals market. And at least in India, all the euphoria shifted to the precious metals market.
Right.
And I see that. So that's why in equity market, it ceased to be euphoria or fear, but the euphoria was in precious metals.
Right. I know that you are not a proponent of gold and silver and all of that, but how do you see this fall? Like the Friday fall, do you see that as an inflection point where people now say, imagine having to see your net worth or a sizable portion of your net worth going down by 25% on a single day? It can scare the shit out of people. Do you see that as something that will again reset expectations and take people to slightly, saner advice that you've been giving around asset allocation?
No, over the last 3 months, we have been facing music because at the end of the day, people want us to value gold and silver and give a number. How do you value gold and silver? As you know, your favorite guru, Warren Buffett, has said it's tough, it's impossible to value these metals or crypto for that matter. So the fact is that we are struggling, but the fact is that you could see euphoria there. And one of the lessons that we had learned is when you see euphoria, you have to realize that people can lose money. That's what we tried to explain to people that in any phase in euphoria, but at the same time, people want to give us a price, want us to give a price target. How to give a price target on gold and silver, which does not have price to earnings, price to book, dividend yield, cash flow, etc. And it is the prices dependent on how many buyers are there and how many sellers are there. So can anyone explain to me a product where in India virtually trading is banned like crypto? Why did it go to 120 and why is it 77 or 77,000 today? No one can predict why it fell from 120,000 to 77,000. Because they're not like stocks. In stocks, at least, there are certain valuation paradigms which have been created by people. How do you
Right.
create paradigms for some of these precious metals and crypto? It's tough. But the way investors were reacting, I mean, it was clear that there was euphoria. And once you have euphoria, it means that people can lose money. But people want us to predict the day from which we lose money, from what price they will lose money, what is the price it will go to. All these things are impossible. I mean, we can tell you that there's euphoria. Beyond that, we ourselves don't know. So, global commodity where we don't know how the global people are speculating on it, we don't know that. But the fact is, it was in euphoria was clear, and we tried to convey it as clearly as possible. But at the same time, people wanted us to correctly predict the top. And even today, people are asking us, is today a buying opportunity? Frankly, we don't know. All we know is we went 2 years back or 3 years back in one of our monthly distribution calls when we recommended silver. We use ratios like Nifty to silver and Nifty to gold. On those ratios, frankly, today they are not justifying any buying. That much we can tell you. But beyond that, we
Right.
can't predict gold and silver.
Right. Understood. By the way, Buffett is not just my guru, your guru also, your favorite guru also.
You
But
have met him one to one, which I have not done. So that's why I called it your guru.
all right, all right. So, Naren, one last question. If you just look at the milieu of products that mutual funds offer, including yours, which pockets do you see? I understand this asset allocation call perfectly, which is what people should follow. But for anybody who's sort of, the base portfolio is set, tactically, what would you recommend today? Is it the banking stocks? Is it small caps? Is it large caps? What would be on top?
For me, it would be specialized investment funds.
Right.
Because people have not yet understood the product and there is a lot of investor education which needs to be done, but it would be that it would not be a single sector, and that is what it would be.
So you have a equity one or the balanced one?
We have launched two.
You've
We
launched.
have launched two, and we don't talk on products.
Understood, understood. But thank you so much, Naren. Such a pleasure talking to you, and
Thank
thank
you.
you for all your insights this morning. That's all we have on the from the studio in Delhi today. Thank you so much for watching. Stay tuned to Money Control for all news, views, and market updates.